I want to bring in Jim Bianco. Jim Bianco, founder of Bianco Research, because as we know, about 90 minutes ago, President Obama effectively said we're going to sign into law and take out $2.4 trillion out of the budget, all right, out of the deficit over the next 10 years. Jim Bianco, you say that is not enough, and as a result, that S&P and Moody's are both likely to downgrade the AAA credit rating of the United States. Explain why it's not enough.
Yeah, you're exactly right. Washington didn't get it. This was never about default. Default was always, I thought, political terms to try and bring people together. This was about downgrade. And S&P and Moody's, not so much Fitch, but S&P and Moody's drew some lines in the sand about $4 trillion or something approaching those numbers in order to prevent default. Washington came up way short of that number. And what we're seeing now is nothing out of Moody's and S&P, because I think they're preparing to downgrade the U.S. And I think that the markets yesterday and today have been reacting in kind that they're expecting a downgrade as well, too.
In other words, the balance sheet, the income statement, whatever financial metric you want to look at for the United States of America is not improved by this deal. That's what you're saying.
Exactly. I think it got worse by this deal because they didn't meet the minimum standards they needed to in order to ensure that the U.S. would remain AAA.
You know, Jim, what's interesting, we've talked a lot about this as we've kind of gone through this process of what's going on in Washington, why we haven't seen more significant moves in the markets. We're certainly seeing in the equity side of things, but we're not necessarily seeing in the Treasury side of things, and we're not seeing in a lot of ways throughout the markets. Why aren't we?
I would disagree with that a little bit. I think we are seeing it in the fixed income markets. If you look at the very short end of the yield curve, overnight repurchase agreement interest rates, if you borrow and put up treasuries as collateral, those rates are going up. The Fed funds rate is up 15 basis points in the last 3 days or so. Overnight LIBOR rates are up. In other words, very short-term funding rates are going up, because most of those contracts, or a lot of those contracts, have written into them that they must be AAA rated securities. And with the downgrade, it's thrown those markets into a lot of confusion. The funding markets is where you're seeing this happen. This is coming out of those markets as well. Now, long-term interest rates are falling because there really isn't a fear that there's going to be no interest payment on a long-term security. And if the funding markets are going to be squeezed by this, it's going to hurt the economy. So we already have a weak economy. The deal's hurting this, and that's what's causing more recession talk and why you're having a rally in the 10-year.
So, Jim, you're saying that that's much more significant because, you know, you read Bloomberg. You know, we've had a couple of stories that talked about other countries that have lost that AAA rating in the past, and there was evidence that the rates didn't go up too much. We also point out, look at the Treasury auctions from last week. We had a lot of participation, more so than we had in June, by foreign buyers and so on and so forth. You just blow that off? You don't think that's significant? Or again, it's just that they're not worried about the longer term picture?
No, the Treasury market has a unique position in all of finance. U.S. Treasuries are a substitute for cash. When people want to talk about cash, they could either talk about actual hard dollars or U.S. Treasuries in the form of securities or repurchase agreements. Now, if the U.S. Treasury loses its AAA rating, the whole idea that it's cash is called into question. It's much different than if a European government gets downgraded or if Japan gets downgraded like it was in 2002. Those securities were not considered cash substitutes. They were actually considered investments with some kind of risk. U.S. Treasury is a different animal, especially at the very, very short end of the yield curve, which is where you're starting to see the turmoil emerge because of a potential downgrade.
All right, Jim, if both you and the short-term lending markets are right and there is a downgrade, what do investors do with their money?
You got to treat this as, this is not going to be a Lehman situation where we're going to have money funds breaking the buck or firms going out of business. Nothing like that at all. I think what it's going to be something that's going to constrict capital flows in the U.S. for some period of time until things get sorted out. Not forever, but some period of time. So what I'm trying to say is it's another thing to slow the economy. It was already slow enough as it was. People were already worried about it, and now the deal they signed today is going to hurt it even worse. And that's why I think you're seeing the markets react to the way they are. They did not meet the minimum requirements for downgrade, and now we're suffering the consequences for it.
And we're definitely hearing more talk of a possible recession going forward. Hey, Jim, we got to run. Thank you, as always. We appreciate it. Jim Bianco.